Let's talk about some of the pros and cons of both the line of credit and the box spreads. I'll start on the line of credit side. Is that pros, again, relatively fast funding, assets are allowed to grow. I still think that that's probably the best use case here, is that you're not utilizing these assets and selling them down. You can continue to have them grow, and hopefully those will grow to an area where maybe you can even satisfy the loan through the proceeds of growth that you've had. So those are possible avenues, but just allowing, not disrupting that long-term compounding that we've talked about before, I think is really powerful. Flexibility of use. And I know both of these have potential tax efficiency. I'm not going to talk about that a whole heck of a lot here because most tribal organizations are already exempt in certain regards. But if you have certain components that are taxable, there is some tax efficiency in both of these, and we could absolutely have that conversation. The cons on the securities-based line of credit, again, large portfolio, limited loan to value. So you're not going to be able to access 100% of this. I wouldn't even say 50% of it would not be recommended on my side. It would be less than that. But how much risk are you comfortable with? Again, it's a risk trade-off argument about how much financing can you do on this asset base and still be comfortable that you can meet the margin requirements if the market were to have a downturn. On the box spread side, there's some very high similarities in the effect of it's relatively fast. It's slower than the securities-based line of credit, but it's still faster than traditional bank financing. Again, assets are allowed to grow and you have flexibility of use. You do have some potential tax efficiency in these as well. Again, that's if applicable. And so I'm not going to spend a ton of time here. But this is probably one of the different attributes from the securities-based line of credit that's important, is that you have a fixed interest rate here, and they can often be at pretty favorable levels, sometimes just slightly over treasury rates. And so you really have, again, it's based upon the structure, the length, the amount of assets that you're investing and borrowing against. So it does have a variable structure at the outset in the effect of you don't know immediately what it will be, but it is a fixed rate loan going forward in the effect of you get the cash up front and you know how much cash you have to pay at the end based upon the quote unquote interest. Here's the biggest con, in my opinion, is there is a high degree of complexity in this. This is not something we would recommend that you all do yourselves. This requires professional guidance and professional support to understand what it's setting up, to understand the terms, and also to execute and implement on the strategy. I really recommend professional advice for this if you want to take advantage of a short box spread to do some financing down the road.